This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance.
Welcome to the Luxembourg Fundcast.
Before we continue, we'd like to mention that the Luxembourg Fundcast is created and produced by Bertrand Mariot, a practicing regulatory lawyer admitted to the Luxembourg and Paris bars. The mission of this podcast is to bring clear, free, and reliable information sourced from official references that are carefully curated and continually updated and refined through high-standard, evolving prompt and context engineering on Luxembourg's financial regulation and investment funds to professionals and anyone interested in the Luxembourg Financial Center. And welcome back. So today's deep dive is based on everything we know as of October 15th, 2025.
That's right.
And our focus is really this immediate regulatory challenge hitting fund managers, particularly here, but also across Europe. It's Luxembourg's, urgent transposition of AIFMD 2.
The Alternative Investment Fund Managers Directive 2.
Exactly. And we're zeroing in on the complex new rules for loan-originating funds. That seems to be where a lot of the action is.
It really is. We've got draft bill number 8628 right here. This is what officially kicked off the legislative process in Luxembourg to get Directive 224927 onto the books.
Okay.
So our mission today really is to dissect what this means operationally. Boots on the ground. And we'll use the SCSp, the Société en Commandite Spéciale, as our main example. It's just so popular.
Makes sense. It's the go-to vehicle for so many. So look, if you manage, advise, or frankly invest in private credit, this means you need to be thinking strategically, like right now.
Absolutely.
We've boiled down our sources into sort of three core takeaways, things you absolutely need to know.
Okay, first one. The clock is seriously ticking. Luxembourg's put out draft bill 8628. That sets the hard deadline, April 16th, 2026.
Right.
This isn't some far-off date anymore. It's basically, an 18-month sprint now? Or less?
Right. Less, yeah. It's an operational sprint starting now. Second point.
Second, strategy is getting squeezed. These new rules, they impose real hard constraints. Think 5% risk retention.
Which we'll get into.
Definitely. And strict leverage caps. 300% for closed-ended funds, 175% for open-ended. These aren't suggestions.
No, they're hard numbers.
Yeah.
Okay, and the third takeaway.
Third, the LPA, the Limited Partnership Agreement, that's the new battleground. Especially for flexible structures like the SCSp, all these complex rules, they have to be written into the LPA.
Which means?
It fundamentally changes the game for GPLP negotiations. It's a whole new level of complexity in the core fund document.
Okay, let's unpack this regulatory shift a bit more. Starting with the bigger picture in Europe. AIFMD 2, Directive 2024-927. This didn't come out of nowhere, right? It's been cooking since 2020.
That's right. The review started back then, and really the driver was just the massive growth in private credit. Unprecedented growth.
Regulators felt they needed to catch up.
Exactly. They needed to harmonize the rules for AIFs, alternative investment funds, especially given how much non-bank lending was happening. The aim? Well, it's stability, investor protection, and, building a more integrated single market for these kinds of activities.
And Luxembourg's reaction? Pretty fast, wouldn't you say? Bill 8628 dropped just a few weeks back, October 3rd, 2025.
Swift, yes. And that gives us that clear, albeit tight, timeline. The target date for the law to come into effect is April 16th, 2026. That's the key date.
But first things first, who does this actually apply to? How do you know if your fund is caught? What's the definition of a loan-originating AIF?
The crucial question. It's a two-part test, basically. Your fund is covered if its main strategy is originating loans. That's one trigger.
Okay, the primary strategy test.
Or, and this is the hard number, if the notional value of the loans it has originated hits at least 50% of its net asset value, its NAV.
50%, that's the quantitative line in the sand.
Precisely. If you cross that 50% threshold, you're in this regime.
Now, what about older funds? Funds already up and running.
Good point. There's some important stability built in. The sources talk about significant grandfathering provisions.
Meaning?
Funds that were set up before April 15th, 2024 get a bit of breathing room. A 5-year transitional period, actually.
Okay, so until April 16th, 2029.
Exactly. That 5-year window lets these legacy funds adjust their strategies, amend their documents without having to immediately comply with everything, especially those leverage and concentration limits. It avoids, a sudden shock to the system for existing structures.
All right, let's shift to Luxembourg's specific approach here. The sources mention this idea of a no gold plating strategy. Why is that phrasing significant? What does it signal?
Gold plating. Yeah, that's jargon for when a country adds its own extra rules on top of what the EU directive requires.
Piling on, essentially.
Right. And Luxembourg has deliberately chosen not to do that. They're aiming for a one-to-one transposition. Stick to the directive, nothing more.
And the signal is?
It's a strong signal, especially to international sponsors, say from the US or the UK. It says, look, Luxembourg is predictable, it's stable. The rules you understand at the EU level are the rules you'll find here.
So less regulatory friction, fewer nasty surprises.
That's the goal. It keeps things competitive, minimizes uncertainty, basically reinforcing Luxembourg's position as a place where managers know the score.
Okay, and that pragmatism seems to extend to how they've handled consumer loans, too. It looks like a careful balancing act.
It really is. Quite sophisticated, actually. There's a territorial restriction. AIFs based here cannot grant loans to consumers in Luxembourg.
Okay, so local consumer protection is locked down.
Correct. But, and this is the key part, the bill explicitly allows Luxembourg AIFs to lend to consumers in other EU countries, provided, of course, it's allowed by the local law in that other country.
So a fund manager can run a pan-European consumer lending strategy from Luxembourg.
Absolutely. As long as the fund's investment policy clearly carves out, excludes lending to consumers who are actually resident here in the Grand Duchy, it protects local standards but keeps the door open for valuable cross-border business.
Now let's get down to the nuts and bolts. The SCSP, the Special Limited Partnership. We picked it because its flexibility, its contractual freedom, means the LPA, the Limited Partnership Agreement, is everything.
It's the central nervous system of the fund.
So if AIFMD 2 brings new rules,
then the LPA has to change. We're talking significant redrafting across key clauses.
Okay, walk us through it. Let's start with investment strategy and restrictions. How does that change?
Well, previously, the LPA might have described the strategy in fairly broad terms. Now, these hard regulatory limits need to become binding contractual promises, covenants.
Give me an example. How does a number like that 20% limit get baked into the contract?
Okay, take the concentration limit. The LPA now has to state clearly that the fund cannot lend more than 20% of its capital to a single borrower if that borrower is, say, a bank, another AIF, or a UCIs.
So it's not just a guideline anymore.
No, it's a hard stop written to the contract. And think about what that means. It restricts who the fund can lend large amounts to, forces diversification, maybe complicates relationships with key counterparties. It impacts risk modeling directly.
And the risk retention piece, that 5%.
Same story. If the fund originates loans and then sells them on the secondary market, the LPA has to explicitly detail how the GP will comply with keeping that 5% skin in the game. What's the mechanism? It has to be spelled out. Crucial for anyone doing securitizations.
Okay, what about the leverage clause? That must look pretty different now.
Completely transformed. The LPA must now clearly state those hard caps, 175% for open-ended, 300% for closed-ended funds. And importantly, it has to specify they're calculated using the commitment method.
Can you quickly remind us what the commitment method generally entails?
Sure. In simple terms, it looks at the maximum potential exposure the fund could have based on its commitments, often including undrawn commitments. It's usually seen as a more conservative way to calculate leverage compared to just looking at current borrowings. That definition, that calculation method, has to be crystal clear for the LPs.
And for open-ended loan funds, there's more on liquidity, right? Yeah. Liquidity management tools, LMTs.
Yes, another big addition. For open-ended funds originating loans, the LPA must now specify which 2 LMTs the AIFM has picked from the EU's harmonized list.
Like safety valves.
Exactly. Think things like redemption gates, which can slow down investor withdrawals in stressed markets, or swing pricing, which adjusts the NAV to make sure investors leaving or joining don't disadvantage the ones staying put.
So the LPA has to name the 2 main tools.
It has to name the 2 primary LMTs chosen from the list, yes. And it should probably detail the conditions under which they'd be activated. The Luxembourg bill does add a little flexibility. It says funds can use additional LMTs beyond the main 2, but they have to be properly disclosed. Still, those core 2 are now mandatory LPA content.
When you add all this up, the new limits, the LMTs, needing to embed all this in the LPA, it sounds like a massive job for the lawyers and the fund managers.
It absolutely is. And think about the consequences of getting it wrong. These aren't just regulatory guidelines anymore. They become contractual obligations within the LPA.
Meaning a breach could trigger default clauses.
Precisely. Imagine a fund accidentally breaching the 300% leverage cap. That could now potentially trigger a default event under the LPO itself. This makes those remedy provisions, things like forcing an LP to transfer their interest or suspending distributions, suddenly much more relevant, potentially more likely to be invoked.
So the stakes within the LPA itself are higher now.
Much higher. Getting the drafting exactly right and then having the systems to monitor compliance constantly is critical. And yes, that translates directly into higher operational costs, more legal fees upfront, and ongoing monitoring expenses. It's a significant lift. And that brings us neatly to operations. The directive and a Luxembourg bill really push AIFMs to step up their game internally. We're talking new, formalized policies needed for things like credit risk assessment, portfolio management, valuation.
Right, and AIFMD 2 generally beefs up substance requirements too, doesn't it? Like needing at least 2 senior full-time managers based in the EU.
Correct. That's an EU-wide requirement now.
The Luxembourg bill commentary suggests this shouldn't be a huge shock for local players, that high standards are already embedded here, citing things like CSSF Circular 18698. Is that fair? Surely beefing up credit risk policies is always a major task.
It's a fair point to raise. The argument in the commentary is that established Luxembourg AIFMs, particularly those already managing complex strategies under existing CSSF oversight, likely have robust frameworks in place that align conceptually with AIFMD2's expectations.
So maybe less of a fundamental rebuild for them compared to managers in jurisdictions that had lighter regimes before.
That seems to be the implication. It suggests existing Luxembourg AIFMs might have a bit of a head start, a competitive edge perhaps, because they're already operating under that kind of stringent supervisory culture. They might need refinements rather than entirely new architecture. But yes, implementing or documenting any new policy requirement is still work.
Okay. And connecting this back to the market structure, all these new rules, the LMTs, the hard limits, does this push private credit funds closer to looking like, well, more traditional funds?
In some ways, yes. Operationally, it forces a convergence. Private credit models are adopting features, mandatory liquidity tools, strict quantitative limits that were previously more associated with UCITES or highly regulated liquid AIFs.
Which must have knock-on effects for service providers.
Absolutely. Administrators, depositaries, they now need systems capable of tracking and monitoring these complex rules for private credit funds, things like the leverage calculations, the concentration limits. It blurs the lines and demands more sophisticated capabilities across the board.
But this blend, the regulatory rigor of AIFMD2, combined with the flexibility of something like the SCSp, is that the sweet spot Luxembourg is aiming for.
That seems to be the strategy. Create this regulated but flexible environment. You get the contractual freedom of the partnership structure, which managers love, but overlaid with a robust EU regulatory framework, which institutional investors increasingly demand. It ticks both boxes.
Interesting. And there was another detail flagged in the sources about ancillary services.
Yes, a useful clarification. The bill confirms that AIFMs can provide a wider range of ancillary services. Think IT support, HR functions, even marketing assistance to other companies within their own group.
Why is that significant?
It enables greater operational efficiency. Large management groups can potentially centralize more of their back office and middle office functions in Luxembourg, serving their various entities from one hub. That creates real economies of scale, a tangible financial benefit.
Okay, so the bill is working its way through Parliament now. We need to watch for feedback from the Council of State, amendments. What's the next big thing on the European level managers need to anticipate?
The focus really shifts now to ESMA, the European Securities and Markets Authority.
Right.
They're tasked with developing the detailed rules, the regulatory technical standards, or RTS. These will cover the nitty-gritty stuff, exactly what the reporting templates look like, the specifics of delegation rules.
So AIFMD turns the high-level directive into day-to-day compliance procedures.
Exactly. The RTS are where the directive really meets the road operationally. That's the next wave of detail everyone needs to prepare for.
And one last point, something about depositaries.
Ah, yes, an interesting angle. Luxembourg decided not to take the option that would allow its AIFs to use depositaries based in other EU countries. They're sticking with the strong local depositary market.
Okay, protecting the local industry.
But here's the flip side. Because Luxembourg is maintaining that strong local capacity, the new rules potentially open up a new business line for Luxembourg depositaries. They can now potentially be appointed by AIFs based in other EU member states, especially if those countries lack sufficient local depository services for niche strategies. So it could expand their market reach outwards.
All right, let's wrap up this deep dive on AIFMD, 2-second hitting Luxembourg. Can we quickly circle back to those three main strategic takeaways?
Absolutely. First, the 2026 deadline is real and requires action now. Bill 8628 is on the table. The clock is ticking towards April 2026. Get your transposition plan finalized. Second, regulation is now directly shaping fund strategy. Those hard limits, leverage, risk retention, concentration, they aren't flexible guidelines. They are firm constraints that will dictate how you build and manage portfolios.
And third, critically.
Third, the LPA becomes the key compliance document, especially for SCSPs. Translating these complex legal rules into clear, binding, contractual terms in the partnership agreement. That's a huge task, demanding really careful legal navigation to manage risk and meet investor expectations.
Okay, so our final thought for you to take away today. While we focused on the directive in the Luxembourg bill, perhaps the biggest long-term operational hurdle isn't even fully visible yet. It lies in preparing for those upcoming ESMA regulatory technical standards. They're the ones that will flesh out all the granular detail on reporting, delegation, the operational mechanics, and complying with those detailed RTS. That's likely going to require a significant and probably expensive overhaul of systems and processes for many managers. Get ready for the details.
This podcast is a collaborative and free resource that improves continually, so your comments or requests for new topics are highly welcome, especially on YouTube. We want to be a helpful strength for everyone working in the Luxembourg Financial Center at all levels. We are often asked how you can help us. Well, a great way to help is by subscribing to our shows on all major podcast platforms, including Spotify, as well as on Apple Podcasts, where a 5-star rating would really help us. You can also like our videos and subscribe to our YouTube channels, Rigore Media, and Bertrand Mario Avocats. All relevant links will be available in the show notes. For our French-speaking listeners, you can also find our sister podcast in French. It was the Luxembourg Fundcast for you today.
This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance.